All right, everyone, welcome. If you're heading into finance, you've probably heard the phrase cash is king. And yeah, it is. But what about the promise of cash? That's where things get really interesting. Today, we're going to go on a journey, starting with the solid, certain ground of cash in the bank and moving all the way to the foresight you need to manage what you're owed. It's a huge shift in thinking, so let's jump right in.
Okay, so here's our game plan. First, we'll nail down the basics, what liquidity really is and how companies keep their cash safe. Then we're going to pivot to receivables. That's the promise of future cash, right? We'll get into how they're valued, tackle the whole new world of predictive impairment, which is a game changer, and then wrap up with how companies tell this whole story in their financial statement.
So let's start at square one with the most liquid asset you can possibly have, cash. But, in accounting, it's not quite as simple as what's in your wallet. The big idea, the one thing you really need to remember, is immediate availability. The question is always, can you use it right now to settle a debt? That's the test. And this is where we get into some nuance with something called cash equivalence. The key here is the 3-month rule, and it's a bit tricky. It's not about how much time is left on an investment. It's all about the maturity from the day the company bought it. So think about it like this. A 5-year treasury bond that you buy just 2 months before it matures, yep, that's a cash equivalent. But that same exact bond bought 3 years ago? No way. Why? Because the risk of its value fluctuating over that longer period is just too high.
Okay, but what if you have cash that you can't actually touch? What happens then? Well, that's called restricted cash. If your funds are legally tied up, maybe they're in an escrow account for a big construction project, you absolutely cannot just lump them in with your regular cash. You've got to classify them separately. And whether it's current or non-current all depends on how long that restriction is in place. And here's a really great example of how different accounting standards can tell a different story. When it comes to bank overdrafts, IFRS and US GAAP see things totally differently. Under IFRS, an overdraft is basically part of your day-to-day cash management. But under US GAAP, nope, that's a loan. It's a short-term liability. And listen, for you as a future financial manager, this is not just some boring technical detail. It has a real, direct impact on how you calculate and analyze a company's liquidity ratios. It's a big deal. All right, so we've defined what cash is. Now let's get into how companies actually control it. We're talking about building a financial Fort Knox here, the systems and processes that make sure every single penny is accounted for and kept secure. A classic example is the Impressed system for petty cash. Just think of it as the super official, fraud-proof version of the cash jar you might have in a shared apartment. It's got 3 clear steps. First, you establish a fixed amount of cash in the fund. Step 2, as people spend that cash on small things, they put a receipt in the box. And this is the critical part. No journal entries are made yet. It's all just cash and receipts. Finally, step 3 is replenishment. You write a check for the exact amount of the receipts to bring the fund back to its original level. That's the moment when you finally record the expenses. You can almost think of a bank reconciliation like a detective story for your cash account, right? Your company's books say one number, but the bank statement says a completely different one. Your mission is to figure out why. You're hunting for clues, things like timing differences, a deposit you made that the bank hasn't processed yet, or a check that hasn't been cashed. The whole point is to reconcile those 2 different numbers and arrive at one single true cash balance. Okay, so we've totally locked down the world of certainty, the cash we have. But let's be real, most business doesn't work that way. Very few transactions are immediate cash for goods. So what happens when a company sells something and is simply owed the money? This is where our picture starts to get a lot blurrier. We're moving away from the safety of having the cash in hand and into the world of expectation. And it's really important to understand that not all receivables are created equal. It is absolutely vital to know the difference. For instance, a big jump in trade receivables, that probably means your sales are strong, which is great. But a sudden spike in non-trade receivables, that could signal something way more unusual. Like maybe the company made a big loan to one of its executives. 2 very different stories. Now, here's a really key concept that comes out of modern revenue recognition rules. If you give a customer, say, 2 years to pay for something, you're not just selling them a product. You are, in effect, also giving them a loan. And the accounting rules say you have to recognize that. You have to record the receivable at its present value and then recognize the difference as interest income over those 2 years. It's all about the time value of money. So this brings up the big question. How do we possibly account for the unfortunate fact that some customers just don't pay what they owe? Well, we use a clever little tool called the allowance for doubtful accounts.
It's basically a contra-asset account that lets us bridge the gap between the total amount we're owed on paper and the amount we realistically expect to collect. Historically, there have been two main ways to estimate this, and it really represents a classic accounting trade-off. On one hand, you've got the percentage of sales method. It's awesome for the income statement because it perfectly matches your bad debt expense to the sales that created it. But on the other hand, there's the aging of receivables method. This one gives you a much more accurate number on the balance sheet because it looks at the hard reality that the older a receivable gets, the less likely you are to ever see that cash. Now, this next point is something that trips up a lot of students, so listen closely. When a company finally gives up and writes off a specific customer's account, it has zero impact on net income, none. Why? Think about it, because the expense was already recorded way back when the company first made its estimate for bad debts. The write-off itself is just the final administrative step in a process that began months or even years before. And now we've arrived at the very heart of our journey today, the big leap from certainty to foresight. What we're about to cover is one of the biggest philosophical shifts in modern accounting, and it was a change driven entirely by the painful lessons learned during the 2008 financial crisis. The criticism of the old system was just a bombshell. People realized that the existing rules forced companies and banks to wait until a loss event had already happened, like a customer actually defaulting on a loan, before they could recognize the full loss. It was slammed as being too little, too late. And this led to a massive fundamental change in thinking. We have to stop just reacting to losses after the fact and start anticipating them. And this slide just lays out the shift perfectly. Under the old, backward-looking model, you waited for a trigger. But with the new expected credit loss, or ECL model, you are forward-looking. You don't wait for the default anymore. From the very first day you make a sale on credit, you have to look into the future. You have to incorporate economic forecasts, and you have to estimate the lifetime expected losses. It is all about modeling the probability of something going wrong down the line. So what does this actually look like in practice? Well, one common tool is the provision matrix. You can think of it as a much more sophisticated version of the old aging method we talked about. You start with your historical loss percentages for each age bucket, 30 days past due, 60 days, etc. But then, and this is the absolute key, you layer on a forward-looking multiplier that's based on macroeconomic forecasts. So if you think a recession is coming and unemployment is going to go up, that multiplier increases and you recognize a bigger loss today. Okay. So it's so much of this new accounting world relying on estimates and forecasts. The final piece of the puzzle has to be transparency, right? If you're going to make these big judgments, you have to explain how you did it. And that explanation comes in the detailed disclosures you find in the notes to the financial statements. So that final number you see for accounts receivable on the balance sheet, that's the net realizable value, or NRV. It's super important to remember that this is not the total gross amount that customers owe. It's the company's best, most educated guess about what they'll actually be able to collect in cash. And these disclosures, they are absolutely vital. They're what allow you, as an analyst or investor, to peek behind the curtain and understand the company's thinking. A company can't just pull a number out of thin air and say, we expect to lose $2 million. They have to show their work. They have to show you the whole reconciliation of their allowance account and, crucially, they have to tell you what inputs and assumptions they used, which macroeconomic variables, like unemployment forecasts, they plugged into their model. This quote just sums up the entire evolution we've been talking about perfectly. The role of the modern accountant has fundamentally changed. It's no longer enough to be a historian, just recording what's already happened. Now, you have to be a forecaster, using all the data you can get your hands on to predict what is likely to happen. And that, believe me, requires a completely new and different set of skills. And so that really leaves us with this final big question for you to think about. Because at the end of the day, this isn't just about memorizing a bunch of rules. It's about developing professional judgment, learning how to navigate that gray area between solid historical fact and uncertain economic forecasting. That is the challenge you're going to face throughout your entire career. And I'll tell you what, mastering it is what will separate the good financial managers from the truly great ones.